There's been this constant refrain, why haven't we seen wages grow faster, consistently? And what I would tell you is take a look at the differential between, and I'm going to get technical and I'll explain it, U6 and U3 unemployment rates. U3 is the 3.7% that we all know. U6 includes something that I absolutely don't understand, economist, sorry Steve, for why they call it marginally attached workers. But the best way to think about it is temporary workers who could work full time. Companies have been arbitraging that against each other. If you look at the U6, U3 gap for the last 17 years and track against it wage growth based on the employment cost index, something that the previous speaker kind of just didn't even discuss, which is showing 3.1% already. Over time, that is one of the highest correlated things you can look at. It's been there since we've had all this technology coming in. So again, last 17 years, what it is suggesting with some of the lead indicators is that we're going to be talking about 3.5, 3.6% wage increases in the first quarter. And that, I think, the bond market has to address and the Fed will have to address. So I appreciate everybody saying,
isn't that a big, long way, Tobias, of saying that as slack goes down, wages go up?
Yeah, but you can. Okay. But the way you look at the slack is, this has been the question: why haven't we seen the wage increases?
Because there's been this extra slack out there
in the temporary workforce.
In the temporary workforce, they've gone there as opposed to hiring.
Yeah.
Let's talk about something else, and that is the idea. We began this year with sort of a consensus. The phrase was synchronized global growth. I'm not hearing that so much anymore.
No, I refer to that with investors as kind of the dreamlike scenario that we had earlier this year. Kind of the sun was shining, the birds are chirping, the children are playing, everybody's happy. And we got 12% earnings growth on a pre-tax basis from the S&P 500. And the reason I say pre-tax is because I don't want to get confused by what's happening below the line on the tax cuts and how you dealt with overseas issues on territorial tax treatment. It gets very, kind of wonky. Mm-hmm. But if you looked at next year's expectations, so 2019 bottom-up consensus expectations for earnings was also 12%. So in this wonderful world that you just described of synchronized global recovery, we got 12% pre-tax, and we're not going to get another tax cut, benefiting us next year. 12% just seems too high in an environment where you have some weakness in emerging markets, you have some weakness in Europe, you've got stronger dollar, you've got higher interest charges tied to higher interest expense. That street estimates are too high and needed to come down. And to a certain degree, what we started hearing from a number of companies during the third quarter was, yeah, estimates are too high and we're guiding down, and the market reacted because everyone was way too complacent about this. Our indicators in September were showing, we have something we call our panic euphoria model, was in euphoria. Last time we saw that was January, right before the correction. Mm-hmm. And we were warning investors, guys, there's some stuff out here we got to worry about, and you guys too happy.
After this last bout of volatility, though, where are we in terms of the euphoria level in the market?
So we're back in neutral territory. We're not in fear. I've been out seeing investors the last 2 weeks straight, almost. And what I will say is that people are asking me questions like, oh, at what price do you buy? Or what sector should I buy? I don't see fear. I don't see that capitulation. And again, our models are saying the same thing, but qualitatively, we're seeing the kind of corroboration, if you like. They're shell-shocked. I talked to one guy who was up 17% 3 weeks ago, and he's now down 3% on his portfolio. That's pretty painful. And you mentioned a number of the big names that in tech land have been hurt. I think people own way too much tech still, and every rally is going to be an opportunity for them to lower.
So there's more downside to come.
I don't know if there's downside, but I think there's lack of this wonderful ramp back up into feeling all good and wealthy again. I think that'll take a little bit more time to build up that confidence.